Hello and happy Friday from a wet London. This is Tom from MarketsFlow. It is the 16th of August and we're midway through Friday as we bring you this weekly performance for the week ending August 16th, 2019. As usual, I'm joined by Adam. How are things, Adam?
Oh, things are okay considering the pretty awful weather and the rocky week we've had in markets.
Good to hear. So let's get started. This is Webcast 16 for MarketsFlow's portfolio performance for week ending August 16th. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is FCA authorized, robo-advisor, and digital wealth manager. We're also SEC authorized. With our multi-award winning platform, we use highly scientific methodology to manage our accessible portfolios. You can start investing in our portfolios from £10 and sign up in under 10 minutes. Download our app on App Store or Google Play or sign up on the web. Your deposits are protected by the FSCS for up to 85,000. Before we start, I'd like to run through our disclosure. Your capital is at risk and any financial performance figures refer to the past and that past is not a reliable indicator for the future. With that said, let's cover the important subject. Adam, how have the portfolios performed in the week so far?
Well, up to now, and we're partway through Friday as we speak, with several hours to go before the market close. The high growth portfolio is up 1.67% this week, and it's up 4.39% since the launch of accessible portfolios at the start of June. The growth portfolio is up 1.8% this week, and its performance since the launch of accessible portfolios is at 3.94%. And third and final, the ISA portfolio is up 0.61% this week, which brings it to 2.79% since the launch of accessible.
Thank you. That sounds impressive. So how has the market as a whole performed this week?
Well, this is where it gets more impressive. With those figures I just ran through for our portfolios this week have been achieved against the backdrop of a rather dramatic week, and it's been a down week for markets. I mean, now coming to about halfway through Friday, I can tell you that the S&P 500 is down about 1.1% now, relative to where it stood at the end of last week, which sounds like a bad enough story in itself, but actually for a significant part of this week, it looked quite a lot worse than this. And Wednesday was the most negative day, down about 3% just for that one day. You don't want too many days like that each year. Tuesday had been a reasonably up day, and today so far is turning out to be another something like 1.35% today so far. But to be clear, this is another week where volatility has clearly been showing itself. Things look and feel rather different from, say, July, where we had such a calm market, at least on the aggregate. So looking at our portfolios with their rather positive week in the market, which has had another rather negative one, that's a nice story of our performance to be able to tell. Somewhere between, the portfolios were somewhere between 1.75% better than the market and almost 3%, give or take, the exact number depending on which of the three portfolios you look at. So that's reason to be quite pleased with this week, albeit we have a few hours to go.
Yes, that's right, Adam. And must I add that I think with the way things are, we might be touching all-time highs on our portfolio, so that's another good thing. How are the allocations within the portfolios?
Well, the MarketsFlow signals generated this week painted a pretty negative picture, and only today have begun to look a little less so, with some buy signals coming back into the mix, but still considerably outweighed by sell signals. So these are market conditions that are difficult to settle into and buy and hold exposure. But we did, however, take some risk, mostly in stocks and a small amount of options-based positions. So exposure and allocation were moderate, and with the stock holdings, around half the positions that were taken during the week were held open for only a day or less. But with such a choppy market, it doesn't make sense to hang on to positions too long. We're not trying to squeeze out every last possible cent on the upside, where it becomes risky to do so. We instead of that, applying some discipline to closing positions when the bulk of what we think they can deliver has been delivered. And on the other hand, if a position is producing a negative return, we're also willing to close that if our expectation is that it will simply get worse rather than better.
Right. So volatility has been a big feature this week, or shall I say for the last 3 weeks or so. How has that affected our behavior?
Well, yes, it certainly has been a big feature. There's less contrast between the market aggregate and its components than there was. It's less of a stock picker's market and more of a market timing market, meaning you'd better know when to be heavily exposed and when not to be if you want to outperform it. But not only has actual volatility gone up, so too has implied volatility, meaning that we get paid better when selling options. Now, whether the latter is enough to compensate for these choppy markets is the important question. Because if it isn't and the stock selection process isn't perfect, then you can potentially be exposed to a lot of downside via writing such option positions. So we did not actually indulge in a lot of option writing. The majority of the positions were direct stock. And as I said before, these are very actively monitored and adjusted or closed quickly in some cases.
Thank you, Adam. That's very helpful. How did we risk manage our way through the week?
Well, it's always important to remember that not everything in the market is unattractive all the time, even if the market as a whole feels unattractive. So while being mindful of our signals, which are predominantly negative, and complying with them in terms of not taking positions where they were stock-specific sell signals, we were still willing to go outright into some direct stock and then where it performed, sell into strength. Today provided us with the chance to do some of that. So we're coming towards the end of the week, very light on exposures.
Yes, that's right. And as far as I can tell, this is the lightest we've been for some time now. So what do we need to look forward to from here on and over the next week or two?
Well, I think it's probably going to be an ongoing focus by markets on the stories that everyone's concerned about now. All of these issues that have been getting louder, I think, in the commentary and in the news coverage, trade wars, major economies teetering closer to recession, US interest rate cuts, shape of the US yield curve, whether that's as good a predictor of recessions as it used to be, deterioration in economic data in any number of places around the world, Argentina. Our difficulty, of course, along with everybody else, is not knowing how much of this news is already embedded in the price of what we're buying. And stories about deflation or recession or the resurgence of gold, these manifest themselves over many months, and they don't determine what's going to happen over the next few days. And in our case, short-term price action is what matters, and try to find a way of meshing that together with the long-term economic phenomenon is a very difficult process that ultimately we can't depend on. So, of course, we have to remain mindful of those stories and the factors that are out there in the background and the impending data releases that could potentially be catalysts for pushing the market price action around. But those big stories are not going to be a really big driver of how we work day to day.
Well put, Adam. Thank you. So that brings us to the end of our podcast. Thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's podcast. Take care.